Here are 6 ways the wealthy save money on taxes, ranging from putting their homes in trust to ensuring inheritance for future generations. Some strategies, such as donating to charities through trusts, may appear bizarre, but they are totally legal. Insiders spoke with ultra-rich lawyers and bankers about how these rare approaches work. Americans can give or pass on roughly $13 million in assets without paying federal estate tax because of tax changes enacted during the Trump administration. This tax affects only 0.2% of taxpayers, and they engage top-tier accountants and lawyers to pay as little as possible. This is a wealthy person's playground problem, said Robert Strauss, a partner at law firm Weinstock Manion. Some of these tax avoidance strategies may raise eyebrows, but they are totally legal. For example, taxpayers can place their homes and country residences in trusts that span decades, and any gain in the value of the property does not contribute toward their taxable estate. Life insurance, perhaps the least exciting aspect of financial planning, can be utilized to save tens of millions of dollars in taxes if purchased from Cayman Islands and Bermuda issuers. As the Trump tax breaks expire, estate planning will kick into high gear over the next 2 years. Individuals and married couples can currently gift or bequeath $12.92 million and $25.84 million, respectively, before the federal estate tax of 40% kicks in. However, unless further legislation is passed, that exemption will be slashed in half by the end of 2025. Here are 6 little-known strategies used by the wealthiest taxpayers to pay less to Uncle Sam. Using trusts to distribute mansions and country estates (QPRTs), or qualified personal residence trusts, effectively frees the value of a real estate property for tax purposes. The homeowner transfers ownership of their primary dwelling or vacation home to the trust and retains ownership for however many years they like. When the trust expires, the property is removed from the taxable estate. Even if the residence has risen in value by millions of dollars, the estate only has to pay gift tax on the value of the property when the trust was founded. QPRTs have grown in popularity in the last year as interest rate increases provide additional tax benefit. It appears to be too wonderful to be true, but there are certain conditions. Transferring riches to future generations through trusts lasting up to 1,000 years. Some of America's wealthiest employ generation-skipping trusts to avoid paying wealth transfer taxes and provide for future successors. From the Wrigley family behind the namesake chewing gum business to Jeff Bezos' mother, an Amazon investor. These so-called dynasty trusts allow taxpayers to transmit wealth down to future generations while only paying the 40% generation-skipping tax once. Many governments have relaxed trust boundaries in order to attract affluent clients, with Florida and Wyoming enabling dynasty trusts to extend up to 1,000 years, or around 40 generations. The heirs have lifetime rights to the trust's income and real estate rather than ownership of the trust assets. These trusts can even shelter assets from prospective creditors and protect them during a divorce. Here's how these centuries-old trusts function, and why even longtime lawyers have trouble understanding them. CRTs, charitable remainder trusts, enable wealthy Americans to have their cake and eat it too. Many wealthy taxpayers deduct charitable contributions from their taxable income, but the ultra-rich can turn their altruism into lifetime income. Taxpayers place assets in the trust, receive annual payments for the rest of their lives, and receive a tax reduction. To satisfy the IRS, only 10% of what remains in the CRT must be donated to a specified charity. These trusts can be funded with a variety of assets, ranging from yachts to closely held enterprises, making them especially beneficial for entrepreneurs wishing to cash out while doing good. Unlike QPRTs and CRTs, accepting loans to pay inheritance taxes is closely reviewed by the IRS and involves numerous hurdles to clear. Families with a lot of assets but not much cash can either sell them quickly to meet the 9-month deadline or take out a loan. The estate can deduct the interest on these Gragan loans, which are named after a tax court ruling from 1988. In addition, if illiquid assets account for at least 35% of the estate's worth, families can defer inheritance tax for up to 14 years by paying in installments with interest and effectively borrowing from the government. Auditors have targeted Gragan loans, which have resulted in years-long court battles, although the savings can be worthwhile for wealthy families. Private placement life insurance, or PPLI, can be utilized to convey assets to heirs, ranging from stocks to yachts, without incurring estate tax. In a nutshell, an attorney creates a trust for a wealthy client. The trust owns the offshore-created life insurance policy. The assets in the trust are treated as premiums, and if properly organized, the benefit and assets in the policy are tax-free. It is only relevant to the ultra-rich, often requiring $5 million in upfront premiums as well as a small army of experts to set up and maintain, such as trust and estate attorneys, asset managers, custodians, and tax consultants. Rich Americans have avoided practically every tax reform advocated by President Biden, but Senator Ron Wyden says he is looking into PPLI and the industry's leaders, including Blackstone-owned asset manager Lombard International. For high net worth individuals, the downturn offers one bright lining. It is an excellent time to establish new trusts since people may transfer devalued assets, whether stocks or Bitcoin, at a lower tax base. During a recession, the long-favored grantor retained annuity trusts, GRATs, can provide significant tax savings. During the trust term, which is normally 2 years, these trusts pay a fixed income, and any gain in the value of the assets is not liable to estate tax. GRATs have grown in popularity in recent years as the Federal Reserve has raised interest rates, reducing the profits on these trusts. So there are ways for the rich to avoid taxes. Whether you agree with legal tax avoidance or not, how do you feel about the methods presented here? Leave a comment below. Take care and remember that your money matters.